All righty, Jordan. Well, let's jump into this. I'm sure there will be others trickling in, but we can go ahead and get started on our webinar this month. We're going to be talking about IRAs, individual retirement accounts, the do's and don'ts. We've got a couple changes that we want to inform you due to the Secure Act 2.0 that passed in December of 2022. Changes a few things with IRAs. And so really looking forward to covering some of that material, going over the basics, and also covering 5 things that you may not know about your IRA that you should definitely take advantage of. So just to jump into the topics today that we're going to cover, we're going to first go into what are IRAs, IRA beneficiaries, the different types of beneficiaries and how they're treated, contributions, early distributions, RMDs. We'll go into some protection on your IRAs that you may not be aware of, both creditor and bankruptcy protection, and then cover 5 things that you may not know, as well as self-directed IRAs. We get a lot of questions about those, don't we, Jordan?
We do, Zach. I would say, generally speaking, IRAs can be nuanced, and with Secure Act 2.0, there are definitely advantages clients can take, and we want to talk through some of those in more detail here. So excited to jump in on some of these topics.
So first, just to introduce IRAs, we're talking about 2 different IRAs mainly today, the Roth IRA and the traditional IRA. Many of you are very familiar with both of these, but just to kind of set the foundation, Roth IRA is after tax. You make that contribution, you don't get a deduction, but what you do get is the earnings are growing tax-free. Now, one thing that you may not know about IRAs is there's no age limits on contributions. The key thing is that you have to have earned income. So dividends from your portfolio interest, that's not earned income. That's your portfolio income. Earned income is W-2, 1099 wages. That allows you to make contributions into your IRA. When these distributions are qualified and you're taking out those withdrawals, they're tax-free. But you do need to be aware of a couple of things there before you take a distribution. The benefit of a Roth IRA is there's no mandatory required minimum distributions. Because it's already after taxes, there is no RMDs for a Roth IRA. So this tends to be best suited for those people who are close to retirement. They may not need the deductions, or they're over the deductible limit for that type of traditional IRA, and really can be a huge benefit if we use this correctly. Jordan, I'll let you jump into the traditional IRAs.
Yeah, to segue here, the difference between a traditional IRA is you are contributing dollars pre-tax, or even in certain cases after tax. So a traditional IRA may allow you to make pre-tax contributions, and they're best suited for individuals who expect to be in a lower tax bracket when taking withdrawals. So the benefits to a traditional IRA include contributions may be tax deductible, and it depends on your income limits, and we'll dive into some of those thresholds in terms of what phase outs could look like. In addition, withdrawals of pre-tax contributions and earnings are taxed at ordinary income during retirement. So as an example, if you think of 3 different tax buckets in terms of after tax, pre-tax, and tax-free, whenever you take draws out of a traditional IRA, they are most likely going to be taxable to you at your highest income. So that's a consideration that does need to be made in terms of whether you choose to make contributions to a traditional IRA or Roth IRA as well. We'll dive into some of the details in terms of what are discrepancies between each of them.
So go ahead,
Zach.
I was just going to say, here's some of those income limits for a Roth IRA. Modified adjusted gross income less than $144,000 in 2022. In 2023, that's $153,000. Now, for traditional IRA after tax dollars, there is no income limits. This chart can be a little deceiving because for pre-tax, getting the deduction of contributing to a traditional IRA, there are income limits and phase outs for that. So many of you are familiar with the backdoor Roth strategy that we implement with a lot of our clients. The idea is that you're making after-tax contributions to your traditional IRA, meaning what you put in is your cost basis and you don't get a deduction for it. But then we immediately roll that over and convert it to a Roth IRA. So there's no income limit making an after-tax contribution to a traditional IRA or a non-deductible. And there's no income limit to converting it over to Roth. So in a way, you're able to sidestep part of the tax code and make that backdoor conversion through this approach. And so that's a strategy that a lot of you have implemented with us. If you have questions about that, we'd love to discuss that more. Now, going into some of the penalties from a traditional IRA, they're taxed as current income. And there could be an additional 10% penalty if the money is withdrawn before 59.5. And there's a few exceptions that we're going to go into in just a moment. Roth IRA, you're allowed to take out those contributions, penalty and tax-free. But what you need to be aware of is some of those conversions, bucket number 2, and the earnings on your contributions and conversions. That's where you can get hit with some taxes and penalties, depending on when you're taking the distribution.
Next, a really important category of whenever you have any type of IRA is from an estate planning standpoint. You want to make sure you have beneficiaries on file, but what's really important is the type of beneficiary. So the IRS categorizes 3 types of beneficiary. There's eligible designated beneficiary, non-eligible designated beneficiary, or non-designated beneficiary. So that's a lot of nuances in terms of how the IRS categorizes what beneficiary category you fall under. The way I think of it is an eligible designated beneficiary is going to be a spouse. And so if a spouse predeceases another, that spouse gets to treat the IRA like their own. So the stretch still applies. So they take required minimum distributions at their required beginning date age. So they, in essence, treat it as if that spouse was never living. They roll over their IRA into their own and they treat it as their own. Non-eligible designated beneficiaries you can think of as a child. And so if the husband and wife have passed and now the child inherits the account, they inherit what's called an inherited IRA. They are subject to a 10-year rule. So how that is categorized is they are not required to take required minimum distributions, but after year 10, all of the money needs to be withdrawn out of that IRA. So if you defer taking any type of distribution until year 10 and you have a very, very large IRA, you're in for a pretty sizable tax bite in terms of everything needs to be withdrawn, categorized as ordinary income in year 10. Number 3, non-designated beneficiary. So there was no change per the Secure Act 2.0. So that's still subject to the 5-year rule. So think of that as if a trust is my beneficiary, it is likely going to be subject to the 5-year rule as opposed to the 10-year rule or the stretch. In essence, meaning similar to the 10-year rule, after 5 years, all of these dollars need to be withdrawn out of the IRA and presumably moved into the trust, causing a really big tax impact. So whenever you are listing beneficiaries, it's very important to consider how they're going to be categorized through the lenses of the IRS and what those required minimum distributions need to look like. So there's a few case studies here, and Zach, you'll dive right into that in terms of not having a correct beneficiary on file and showing what the impacts look like down the road. So Zach, if you want to switch to the next slide here and dive into what that court case looked like, I think it's pretty powerful.
Yeah, absolutely. So this is a case that went all the way up to the Supreme Court, Kennedy versus the plan administrators for the Dew Point Savings Investment Plan. William Kennedy had worked, participated in the company 401k. He had named his wife, Liv, as the primary beneficiary. However, unfortunately, the couple divorced, and Kennedy did not update his beneficiary form. Again, it just emphasizes the importance of being aware who's that beneficiary. When he passed away, his daughter from the previous marriage claimed that she was entitled to the assets of her father. But Liv, the ex-wife, argued that she was still the rightful beneficiary because Kennedy had not updated his designated form. And the Supreme Court has been very clear on this. Even though William probably would have preferred all of the assets to go to his daughter rather than the ex-wife, because the ex-wife was the named beneficiary, she was the inheritor of all the assets. And so this is just clear over and over again. Now, I kind of want to go back to what Jordan was talking about with these different types of beneficiaries. This is also really important. One way to look at it is, what type of runway do you want to give your kids and those beneficiaries? Do you want them to have a long runway or a short runway? And how you select that beneficiary really can give them that runway. It can force them to be required to take out all the money within 5 years. And especially if they're still working, that can be very costly. While they're still working, they're forced to take out all this money, and now they're being taxed if it's a traditional IRA. Roth IRA, obviously they wouldn't pay any taxes, but you want that to grow tax-free as long as possible. So really, if you have questions about that, we'd love to talk to you about how we can extend that runway for you and implement some strategies there. Jordan's going to go into talking about some of the contribution limits, and those did increase. So I'll let him jump into that.
Yeah, thanks, Zach. So for 2023, the contribution limits did increase by $500 per taxpayer. So if you are under age 50 and you are single, you can contribute up to $6,500. If you are married, double that, $13,000 in total. The IRS allows you to make a catch-up contribution if you are over the age of 50. So instead of $6,500, you can do $7,500 in total. Married, $15,000. An interesting nuance here is, as an example, husband and wife, and you have one of the spouses who's the sole bread earner and the other is not working. As long as the bread earner is making at least $15,000 a year, you can make a contribution not only for the spouse that is working, but also for the spouse that is stay at home. So that's something to consider in terms of, just because one spouse does not have earned income, as long as you have one that has enough to facilitate contributions on behalf of both partners, you can make maximum IRA contributions. Now, you don't have to make the maximum amount, but nonetheless, those are the IRS income limit thresholds. So some things to consider: just because you may be working and the spouse may not be, does not mean the spouse not working is not entitled to make contributions. So that's something to keep in mind, and something we run into a lot in terms of a lot of our prospective clients may not have known those caveats and rules there.
Let's talk about early IRA distributions for just a moment. This can get a little tricky. There's exceptions for plans and IRAs. There's exceptions for IRAs, and there's exceptions for plans only. Because this is an IRA webinar, we're going to focus specifically on the IRAs, but a few exceptions to that 10% early withdrawal distribution. So keep in mind, if you're taking money out before 59 and a half, and you don't meet one of the exceptions, on top of the taxes that could be due, you're going to owe a 10% penalty associated with the distribution. So a few of those exceptions for both plans and IRAs: death, disability. Those are some of the big ones. Death, once the assets are moved over to the inherited IRA, the inheritor of that you can make those distributions due to the death of the IRA owner. Higher education expenses is another one. I'm going to skip this 72T and come back in just a moment. But higher education expenses is a common one to avoid those 10% early distributions. A medical expense. Keep in mind with the medical expense, it does need to be 7.5% over your AGI. So you take your adjusted gross income when you file your taxes, and it has to be at least 7.5%. And there's also another nuance on that where you have to actually itemize those deductions. So if you're taking the standard deduction like most taxpayers, you wouldn't be able to do the early withdrawal and avoid that penalty there. First-time home buyer up to 10,000, birth or adoption up to 5,000. Now I want to touch upon this 72T for just a moment. What this is it's another exception, but it's very tricky. This one you're definitely going to want some extra planning and guidance on, but you're allowed to take substantially equal periodic payments, and there's a couple different methods. But the idea is that if you continue those substantial equal periodic payments for the greater of 5 years minimum, or all the way up until you're 59.5, whichever is greater, you can avoid that penalty. This can be very costly if you're young because you'd have to continue those substantial distributions until 59.5, but it could allow you to avoid those distribution penalties that would be associated on that. Jordan, any other thoughts that you would add on to some of these penalty exceptions?
The only other thought, Zach, is these need to be thought through, especially the 72T. I would always recommend speaking with us in terms of just making sure that you fall in line with the IRS guidelines. We certainly wouldn't want you having to incur a 10% early withdrawal penalty. A second opinion here is always needed when it comes to these nuances here. But no, great job, Zach. In terms of the required minimum distributions, the Secure Act 2.0 was very, very favorable to retirees. Before the Secure Act even 1.0 was implemented, your required beginning date, meaning that when you need to start taking required minimum distributions for everyone, was 70.5. And then we had the implementation of Secure Act 1.0 and 2.0. And now, if you are born 1950 or earlier, your required beginning date is at age 72. This means that you are required by the IRS to take out a minimal amount from your IRA. Now, what is that minimal amount? It starts off at about 3.6% and it incrementally increases. So your RMD is a function of two factors. One, your age. Two, the IRA account balance. So as an example, we work with many clients who have several types of accounts. Most commonly, husband and wife have IRAs, and then they may have a trust or individual account. And so the RMD is just a function of the taxpayer's IRA who has turned either age 72, 73, or 75. So as an example, if you have $1 million IRA, you're needing to withdraw about 3.6% just of that IRA at your required beginning date. So if you're between, again, 1951 to 59, your required beginning date is 73. Any any age born after 1960, your required beginning date is age 75. So that's a great win for retirees with what Secure Act 2.0 implemented here, is we can defer taking these required minimum distributions until later down the road. Now, you're certainly entitled to withdrawing dollars out of your IRA, but you are not mandated to. As long as you're over age 59.5 and have held the account for at least 5 years, if you're in a Roth, no tax penalties whatsoever. But the IRS does require these mandates, and that's the benefit to building out your financial plans in terms of we can forecast what those distributions look like and do some very, very in-depth tax planning for you, knowing that, hey, you have this required minimum distribution coming up. What can we do to minimize the amount taxes that you're paying.
And John, and add to what he's saying here, a lot of clients say, you know, I'm retired or I'm close to retirement. And I can think of two particular clients on this webinar today that this would apply to, where they don't necessarily have the earned income, or they won't in the near future. And so those contributions are going to stop. But then there's a gap all the way up until 73 or 75 until those RMDs begin. That is one of the best windows to really do some tax planning in your IRA. Making those conversions, moving some of that money from the traditional IRA strategically over to the Roth, that is the best window, because after those required minimum distributions begin, now you have to satisfy the RMD before you can make a conversion. And so you're required to take out a lot more in order to effectively move this money to Roth. And what we know is that tax rates are at a historical low. Now is the best time to be doing some tax planning. And when you make that conversion, you're locking in what tax rate you're paying versus leaving it up to the future and letting that be a guess. You know, we don't know what the tax rates in the future are going to look like. Are they going to increase? And if so, that's going to be more costly for you to get this money back to you. Recently went to a conference, and the expert of IRAs in America, Ed Slott, said that a traditional IRA is an IOU to the IRS. So an IRA is an IOU to the IRS, meaning you still have a bill due on that money. And at some point, you're going to have to pay the taxes. I thought that was put very well.
Great. In terms of creditor protections, whenever we're rolling over dollars out of an ERISA qualified account, so let me define ERISA here. And the main purpose of ERISA is to protect the interest of workers who participate in employee benefit plans, including certain type of retirement and healthcare plans. So anytime you are rolling over dollars out of your employer-sponsored retirement account into an IRA, you will lose some of those ERISA protections. Nonetheless, you are still entitled to bankruptcy protection. So as of 2023, IRAs are protected up to a balance of over $1,512,350 in total. So although you lose some of the ERISA protections, they do follow state rules, and you are protected from bankruptcy up to the $1.5 million threshold. So just because you roll over dollars out of a employee-sponsored retirement plan does not mean that you lose a lot of protection. So there's a worksheet that we'll go through when we're talking through making recommendations of moving dollars out of an employee-sponsored retirement account that speaks to, hey, what are the benefits to doing so? What are the pros? What are the cons? And is this the right time for you to do so? So these are all considerations that need to be made, but wanted to let our audience know of some of the nuances taking place behind the scenes in terms of creditor and bankruptcy protections.
Okay, jumping into 5 additional things that you may not know about your IRA. For children can have IRAs. Minor Roth IRA is very common in the industry. Again, it comes down to these children have to have earned income. There's no such thing as a parent using their earned income to contribute for a child. The child has to have that earned income. So, you know, whatever that is, they're allowed to make those contributions. Number 2, IRAs can be transferred or rolled over. So if you have outside IRAs, you can always convert those or roll them over, depending on what type of strategy we're implementing. But we can roll those over and merge into one account, tax-free. If we're going from a traditional to a traditional or a Roth to a Roth, there's not going to be any penalties associated with those types of transfers. Jordan, I'll let you jump in here with some of these additional items.
Sure. Yeah, in terms of needing to take required minimum distributions from inherited IRAs, you might need to. And so In terms of when the initial owner passes away, in a year where the RMD was not satisfied, the individuals who inherit the IRA are needing to take the required minimum distribution since it was not satisfied. So that's a very common occurrence of when we're dealing with a husband and wife, for example, and the husband was taking required minimum distributions and he passes away. And so if he passes away early in the year and he has not satisfied his required minimum distribution, the spouse does need to satisfy that before that is rolled over or moved over into her IRA account. So there are some nuances in terms of needing to take required minimum distributions either from inherited IRAs or from IRAs that are inherited by spouses. And so again, if the account owner has reached required minimum distribution age before they have passed away, you do want to speak with your financial advisor and talk through what some of those nuances are, just to make sure there is not an oversight, because if you miss a required minimum distribution, there could be some pretty substantial penalties levied by the IRS. And again, to Zach's point, what he alluded to, think of a traditional IRA as an IOU to the IRS. So although you are deferring dollars, potentially even deducting dollars while you're making those contributions, whenever you take out money from the traditional IRA, it's again going to be taxed to you at ordinary income rates. So think again of three different tax buckets. You have your after-tax bucket, you have your tax-deferred bucket, and you have your tax-free bucket. If you have a very, very, very large tax-deferred bucket, meaning that you have IRAs or qualified accounts through work, whenever you're taking money out of these accounts, you're paying ordinary income on the federal side, and it depends on what state you live. You could also be paying state taxes as well. So considerations to Zach's point is you want to make sure that we do that as your financial planners, we plan out from a tax strategy standpoint, we're building out these different tax buckets for you. So although we want to certainly grow your retirement account, we want to be very cognizant of how we're growing each tax bucket for you. So again, we can facilitate Roth conversions during times when either there's market volatility or you've discontinued employment and income has lowered, and now it makes more sense to facilitate these Roth conversions down the line, in essence, paying less in tax. So there are a lot of strategies that can be employed, but just be aware if you have a very, very large tax deferred bucket, that's an IOU to the IRS.
In addition to that, there was some additional clarification on qualified charitable distributions. We call them QCDs. What a qualified charitable distribution is, it allows individuals who are 70 and a half or older to donate up to $100,000 directly to a charity from their taxable IRA. And this is really a triple win for the IRA owner. Number one, it satisfies those required minimum distributions. So if this is something that we're doing at age 73, 74, 75, after those required minimum distributions have been turned on, it will satisfy that. Number two is you don't have to recognize it as income. And so we have a lot of clients, very charitable, donating to various causes, many to the church through tithing. And so they're able to make these QCDs, satisfy the RMD, avoid the taxes with the distribution, and also get the deduction for contributing to charity that they can then itemize. And so this can really be a huge advantage for someone who has charitable intentions with their money.
And lastly, we'll circle back to avoiding self-directed IRAs. And so we don't see this very often, but you may have read an article of pros and cons of self-directed IRAs. And in essence, what a self-directed IRA is you are owning tangible real estate within your IRA. So there's a lot of nuances associated to doing so. What we've seen with clients we've worked with is it can be costly, it can be cumbersome, and it can also be a little confusing in terms of each custodian has different rules in terms of what you can and can't do. For example, if you own physical real estate, think of a rental property, you can't claim depreciation, annual deduction for repairs, mortgage, interest, property taxes, losses against other personal income. So we, in generally speaking, try to avoid self-directed IRAs for some of the reasons that I just listed here. But nonetheless, if that's a consideration you're making, we would caution you against it. Each custodian, again, follows different rules in terms of what you can and can't do. So those are considerations to keep in mind in terms of opening a self-directed IRA. It does have its nuances. So mainstream custodians like Vanguard and Fidelity do not allow you to open these type of IRAs. And so you have to work with specialty custodians. And so when doing so, we just don't know a whole lot about them. So a lot of caution is given in terms of if you want to travel down that road, it's not something that we often recommend folks doing.
Just to add on to that, the penalties can be very costly. Even as extreme as losing the IRA status, which basically means that you've taken a withdrawal of all of your funds in your IRA. So, one of the often mistakes in these self-directed IRAs is self-dealing, meaning what happens with these self-directed is you have to use everything for that real estate property covered from your self-directed IRA. You can't use this self-directed IRA to buy the property, but then you use some money from your checking account to perform some maintenance. That would be a self-dealing issue where then you would most likely run into an issue where you would lose that IRA status. And losing that IRA status, having it all withdrawn in 1 year can be very, very costly, especially if it's a big IRA. It's going to be taxable all that year. If you don't have any other questions, we appreciate you guys joining us today. Thanks for taking this time, and let us know if there's anything else that we can do.